So, moving down to the free cash flow summary. This is where the magic happens, so to speak. So, what you're going to be doing here is looking at a summary up top, up here. It's pretty much a summary of your operating metrics. So, your revenue minus your costs to come up with EBITDA. And then from EBITDA, you get your free cash flows. So, you're going to take out your interest expense, capex, and taxes. And then you're going to account for any changes in net working capital. If you don't know what working capital is, please go look that up. That is essentially the current assets that minus the current liabilities that a company needs to operate on a day-to-day basis, but it does affect your cash flow. So that free cash flow down here on the bottom, that's going to be what we have to pay off this debt that we've taken on to do this deal. So if we move down to our capitalization table down here, you can see that as we move from left to right, our revolver and our term loans are starting to decrease in value. This is because as you pay down, so if you look at these values here, your first term lien and your second lien term loan here, okay, these are the debt that you've taken out in order to buy this company, and as you generate free cash flow up top, it's going to flow down and start to pay down that debt. And as you pay down that debt, the sponsor's equity share is going to grow. And that's what makes an LBO so profitable, is that by the end of year 5 or year 7, your equity share will have grown from something around 33% to hopefully 50 to 60%, and then you can capture, you can double your money in like 5 years and get 15% IRR. But that's how that works. And if you have a successful LBO, you should start to see your debt paid down. So if we read this note here that Julian's left, pretty much summarizes what I just said, but it gives you an in-depth look at the debt paydown. So ideally, he says you should be paying down 100% of your first first lien debt, and at least 50% of total debt with somewhat conservative estimates. What does he mean by conservative estimates? We're going to get into that in a second in the operating schedule, but remember, you'll remember that Miles and Julian said that a large part of this case competition was your ability to estimate and project out how this company you're buying is going to operate in the future and how successful they're going to be. And that is ultimately going to drive your top line revenue. And if you think about any cost cutting operations or plans that they have in place, maybe you'll drive your gross profit. And from there, it flows into EBITDA and your free cash flow. And so your projections for revenue and your operating margins will then directly flow into your ability to pay down this debt and your ability to make money off this LBO. So when he says conservative estimates, he means that you're growing your revenue at a reasonable amount. But we're going to get into that right now in the operating schedule. So operating schedule, this is where you can really set yourself apart in this case competition. So as you can see, we've got plugged in from previous sheets revenue numbers and cost of sales, gross profit, operating expenses, etc. from past years. And then in the future, these blue numbers here, remember blue means this is what you're changing. The blue numbers here are going to be how you think the company is going to do in the future. So it's kind of blocked here by his note, but you've got percent growth, upside, base case, and downside. So remember up here on the control panel, we can flick through the upside, base case, and downside in order to see our IRR quickly. But down here, this is where we're going to project out. So if I think that in 2016, in an optimistic case, the company is going to do 5% more revenue than they did in 2015, I'm going to put 5% in right there. And with that, because of how this model links up, my revenue will increase, which will increase my EBITDA, my free cash flow, and then increase the amount of debt that I'm able to pay down, and it'll flow through to my internal rate of return, and it should start to affect things up here in the control panel. So if we change that again, if I change the operating case to 1 so that we're in the upside case, and then I change my upside revenue percentage growth in 2016, you'll see that as I go from 5% to 1%, my year 7 IRR up here is changing. So once again, 5% I've got a 13.3% IRR, 1% I've got a 12.5% IRR. That makes sense, right? As we decrease our revenue growth, we're also going to decrease our internal rate of return. Similar things hold true for your cost of sales and your operating expenses. Obviously, it's rather than a positively correlated relationship, it's kind of the opposite. So as your cost of sales goes up, let's say we spike it to 70%, you're going to lose some IRR in year 7. Same thing goes for operating expenses. As we get to depreciation and amortization, so this gets a little bit tricky because as we increase depreciation and amortization, you can see that our IRR actually goes up. So as we increase depreciation and amortization, our IRR actually goes up. Why does that make sense? If depreciation and amortization is an expense on our income statement and we increase it, you would think that our net income, or the money we make, would go down. But the reason why is because that's a non-cash expense. So you're actually getting a little bit of a tax break there. So that, if you really want to do well in this case competition, I would definitely understand how each of these inputs on your operating schedule is going to affect your IRR. And then, of course, come up with reasons to back up why you are changing these numbers. Remember, Miles said he's really interested not necessarily in how high you can drive this IRR up here. You know, anyone can input 20% revenue growth for the next 5 years and get an amazing IRR. What they want to see is why it's growing so quickly. What in the business strategy is causing such great results? So, moving on. If you move on down to your working capital schedule, working capital, as I said earlier, is really just the current assets minus your current liabilities that you need on hand to keep the company operating on a day-to-day basis. So if you think about it, if you grow your EBITDA by, let's say, $10 million, but because the company has grown, you now need $5 million more worth of inventory on the shelves at any given time, your free cash flow is really only grown by $5 million because even though your income is growing, you need more of it to maintain the business on a day-to-day basis. So these metrics down here that you're going to be changing or adjusting for your projections have to do with those items in your current assets. So days receivable would be the amount of time on average it takes your clients or your customers to pay you for work that you've done, because remember, accounts receivable is revenue that you've earned but you've not collected. Inventory turns would be the amount of times you sell your inventory on average in a year. And then other current assets. Again, we have that encapsulating line item, other current assets, because businesses have lots of different types of current assets, but you're going to assess that as a percentage of revenue. And then down here you have the same types of drivers for days payable, salaries payable, and other current liabilities. So you do not need to edit or change any cells past this point, okay? So this is really just so that you can understand how your model is working. As you can see, we have your estimated LIBOR rates going out here. So as we mentioned earlier, a lot of your debt terms are based, their interest rates are based off LIBOR. So as LIBOR changes, the interest that you pay changes, and that will affect the free cash flow you have left to pay down debt. But I would say don't worry about that so much because they've already given you LIBOR rates. Cash flow sweep just refers to the amount of your free cash flow you're going to use to pay down debt. Looks like they want you to use all the free cash flow to pay down debt. And then at this point, this is a more in-depth view as to how you're paying down your debt. So again, you can see the balance is decreasing. And if you're really interested in this, you can kind of look around in here and see why that's happening. They have mandatory amortization, optional repayments, mandatory repayments. It's fun stuff, but you don't really need to adjust it for this part of the case competition. So now, moving down, if you come down to your IRR calculation, this is something that I'm sure Julian and Miles and all the judges over at Credit Suisse are going to want to know about. You should know this. So the IRR calculation is going to look at your enterprise value, so the growth of the total value of the company over the next, looks like 8 years, okay? And then subtracting from that the debt that you still owe on this company, you can come up with your equity value. And that is the value that is attributable to the financial sponsor. So remember I said that when you buy this company, a small portion of the purchase price is going to be composed of equity from the sponsor, and a larger portion is going to be debt. You can see that here, as we have in 2016. In this example, our debt currently is $4.7 billion, okay? And our equity value is $1.6 billion. And then as we pay our debt down, or rather as we grow our enterprise value, you can see that we've got EBITDA jumping almost 200% here. But as you grow the enterprise value, you can see that debt decreases and our equity value increases. And what that does is, if you discount it back to get your internal rate of return, you have here on an annualized basis your internal rate of return given the theoretical payout if you were to sell the company. So you can see that as we pay down debt from 2016 to 2017, as we grow enterprise value and pay down debt, we get a huge jump in our IRR from negative 83% to 20%. So Miles mentioned in the presentation that they want to see IRRs of about 25% in the upside. That's about in line with private equity industry standards, or what the investors in private equity companies are looking for. But that really, as long as you hit that number, I think they're more worried about the assumptions that have gone into that. And as Miles said, yes, you want to have a good IRR, but really they want to know how confident you are in your ability to hit that IRR. So in summary, this model tab is really where everything comes together. It's drawing from a lot of assumptions from the cover and balance sheet and income statement tabs, where you're going to be setting up the company up to present day, but then in that operating schedule you're going to be projecting out how you think the company is going to be performing, and then from that performance you're going to then apply it to the debt schedule and see how you think they can pay down their debt up here. And then once they pay down their debt, you're then going to pay attention to the IRR and see what type of returns you're going to be getting. Sorry to make you guys dizzy here. See what type of returns you're going to be getting once you pay down that debt and sell the company. So this concludes part 2 of 3 in the video series for the Credit Suisse UCLA second annual investment banking case competition. I know it's a lot to process here, but I would really encourage you to just play around in this model, see how things change as you change those blue numbers, and I think the key to success here will really be how well you understand the working parts of this model. How do things react when you change numbers? So in part 3, we're going to be going over the outputs and the case comparison, and I encourage you to join us then.